So the stock market is flirting with its all-time highs, right? And normally, that's when everyone feels pretty good. But what if it's not what it seems? We're going to dive into one analyst's take that says underneath this calm surface, there are some major warning signs flashing red.
And the whole analysis really kicks off with this one simple and honestly kind of chilling line. It's not a warning that a trap might be coming. It's a statement that, yep, it's already here. It's set, and it's just waiting.
So that's the big question, right? What is this trap? Well, it's the idea that while everything looks okay on the surface, the market's internal health is actually pretty weak, and it's just waiting to catch people who are a little too confident. So let's figure out how to spot it.
All right, here's our game plan. We're going to break this down into 5 parts. First, we'll look at why the market feels so deceptively calm. Then we'll hit 2 huge warning signs from financials and tech. After that, we'll get into this idea of a tale of 2 markets, and we'll wrap it all up with the analyst's actual advice for how to handle all this.
Okay, let's start with part 1, that deceptive calm. From a distance, you might think the market is just, taking a little break. But when you zoom in, you see the specific technical pattern that really explains what's going on. So if you've been watching the S&P 500 lately, this probably feels familiar. It kind of pushes up, gets knocked back down, drifts a bit, finds some footing, and then does it all over again. There's just no real direction. And that's what this analyst calls a balance range.
And here's what that term means. A balance range is basically a period of total indecision. Think of it like a standoff. The buyers, the bulls, they just don't have the juice to break through that ceiling. But the sellers, the bears, they don't have the conviction to crash through the floor either. So everyone's just stuck in the middle.
This is the perfect way to picture it. The market is just bouncing around inside this box. And the trap isn't the box itself. The trap is thinking it's definitely going to break out to the upside just because it's near the highs. The evidence we're about to see suggests that might be a really bad bet. Okay, now let's get to that evidence, our first major warning sign. This is where we start to look under the hood of the market. And we're starting with one of the most important sectors out there, financials. This is a really big deal. Financials are kind of like the plumbing of the entire economy. If that starts to crack, you've got a problem. And according to this analysis, they're not just showing a little weakness. They've actually broken down from a very bearish pattern. Let's get specific. What we're seeing is a classic bear flag breakdown. Now, you don't have to be a technical genius to get this. A bear flag is basically a pattern that suggests the price is likely headed lower. The trend is making lower highs and lower lows. And the analyst's takeaway is pretty blunt. If the financial sector is weak, it's a major anchor on the entire market. So having one of your star players injured is a problem. But what happens when your other star players starts limping too? Well, let's turn to the other massive engine of the market, the tech sector. And wouldn't you know it, it's a similar story here. Just like the financials, the tech sector can't seem to find its strength. It keeps running up against its own ceiling and just gets rejected again and again. So when both of the market's biggest, most important sectors are sputtering at the same time, that is a serious red flag. This quote from the analyst really just says it all, doesn't it? It's not, screaming the sky is falling, but it's a clear sign of real concern. I mean, if the 2 biggest players on your team are struggling, you probably shouldn't be betting on them to win the championship.
So this brings us right to the heart of the trap. It's not that everything is weak. That would almost be easier to understand. The problem is that the market is completely split down the middle, and that creates a really confusing and frankly a dangerous environment.
This quote just perfectly captures the mood. The market is just indecisive. It's conflicted. And that confusion is exactly where investors get into trouble, because they start betting on a clear direction that just doesn't exist. And you can see that split right here. It's fascinating. On one side, you've got these real economy sectors, think materials, industrials, energy, and they're actually holding up pretty well. But on the other side, you've got the market's heavyweights, tech, financials, software, and they are seriously lagging. It's a total tug of war.
And this number shows you the result of that tug of war. The main index, the S&P 500, has gone basically nowhere, a big fat 0%. But underneath that calm surface, the average stock has been on a wild ride, moving about 11%. That's a massive amount of turning around that's being hidden by the flat index.
So what does this all mean? It means with the market this divided, there's a total lack of conviction.
Neither the bulls nor the bears can really take control, and that means any little move up or down could reverse violently and without any warning, and that, right there, is the trap. So if the market is a trap, how do you not get caught? That brings us to the final and maybe most important part, the analyst's core advice on how to actually handle this kind of choppy, indecisive market. And this right here is probably the single most important warning. In a market that has no idea what it wants to do, being super bullish or super bearish is basically a recipe for disaster. Because the second you get convinced it's going one way, it's probably going to turn around and do the exact opposite.
So the strategy here really boils down to 3 simple steps. First, just manage your expectations. A huge, roaring breakout probably isn't just around the corner. Second, you have to stay flexible. Be mentally ready for it to go up or down. And third, and this is the big one, your main job is to preserve your capital. Don't take big, risky bets in a market that's just spinning its wheels. And that brings us to the final critical point. I know. Preserve capital sounds kind of boring, right? But in this specific environment, it is without a doubt the most strategic thing you can do. But why? Because of this. This is the ultimate punchline. This choppy, sideways nonsense, it's not going to last forever. Eventually, the market will pick a direction. A real trend will emerge. And the absolute biggest mistake you can make is to lose all your money fighting the chop. Because then you'll be stuck on the sidelines when the real clear opportunity finally shows up. The goal isn't to win this little battle. It's to survive it so you're ready to win the war.